Okay, a very good morning to you, both Facebook, Assets for Freedom group and YouTube. Very big welcome. It's Monday morning, the sun is shining, it's very chilly. I hope you are fantastic and you had a great weekend. Right, as we come live, let me just make sure the sound is working. I can see a green bar. I can see myself. As you come on, please say hello, introduce yourself. If you are on Facebook, Assets for Freedom, there's a little link you need to press so your name can be revealed, so we can have a conversation. So say hi as you come on. Okay, what are we going to talk about today? It is a market update. We had figures last week from the nationwide house price index, nationwide HPI. So I want to dive into those figures. But before I do that, before I dive into those figures, I want to zoom out again and give an explanation of what these market analysis updates are about, what the channel is about, because we are a new channel. I relaunched this 5-6 weeks ago. My aim on this channel is to give a selection of content, both how-to videos, both case study videos to help investors get into the property market or grow their property business, as well as topical videos to talk about more sort of macro events that are going on, budgets, banking crisis, things that might influence decisions. And finally, looking at market analysis. I think it's really important to understand what's going on in the market. I want to make something very clear. When I look at market analyses, my aim is to give a objective and fact-based overview of what's going on. I'm trying not to go subjective. I'm trying not to make predictions because, quite frankly, predictions are generally wrong, but give you data that's out there in as balanced a way as possible to try and make people make better decisions. On the last live I did last week, I said that in the past I've made poor decisions based on jumping into something without really understanding the data. Now, why do I say this? Hey, nice to see you guys on. Why do I say this? Somebody called me out on Facebook on Friday. Actually, it's not on YouTube, on Facebook. My personal view is Facebook has gone a little bit toxic and is a bit of a breeding ground for toxicity and conflict and conspiracies. But somebody called me out, and I love being called out. It was quite an aggressive call out. I'll just read out to you what was said. And this is on my personal page, by the way, not on a group or anything like that. Selective use of data means junk in, junk out. Typical guru looking for mug punters. I'd never be your friend. Fraudsters like you should be locked up. Preying on the gullible is unforgivable. So there's a little reason behind the slightly tongue-in-cheek thumbnail to this video. And that's the use of data. So I fully agree with the sentiment, by the way, that data needs to be understood in the context of many things. And often life is not black and white. There's lots of complexity, lots of contingent things that are fighting with each other, which gives an interesting picture. So over the last couple of lives, I've put out data which is all kind of going one direction at the moment. A lot of the trend lines are going one direction. And when I look at data, it's really important for me personally to look at the overall trend line. If we zoom out and look at a trend line, and the data we've been looking at, UK HPI, nationwide, which we're going to look at again, has been trending down. But I accept the challenge. I would say that if anybody wants to challenge data or put alternative viewpoints in, absolutely would love to see those alternative viewpoints. It's what we do, is we discuss things. I want to create discussion so we can all make better and more informed choices. And if the data I'm putting out is rubbish, call me out on it, right? Just do it in a constructive way. That's all I'd ask, because I'm just putting out facts, not making predictions. So if anybody, hey, how you doing? Back from sunny Cornwall. Nice to see you. So if anybody has a viewpoint on what you think is going on in the property market right now, put it in the comments. Whether you're on the live right now or you're watching this on the replay, my aim is to create discussion, create community. So what do you think? Where do you think the housing market is going right now based on the data that you're seeing? Okay, because there is confusing data. And I do accept that data needs to be looked at from every angle. So what I am committing at doing is actually putting out a video, sort of standalone video that I'm probably going to record next week, which is the contra argument to property prices coming down, which is what actually is going to prop them up, or what could prop them up, or what could reverse the trend. I think it's difficult to argue that it looks like in the current cycle we have peaked and are pulling back. Where is this going to lead? I think this individual called me out quite aggressively on Friday because he thought I was calling for a massive market meltdown, massive market crash. I just want to say that's not what I'm calling in the slightest. My personal view, this is not a prediction. My personal viewpoint is that for the rest of this year, maybe into beginning of next year, 2024, we're going to see a pullback of the market in what I hope is a sustainable and gentle way. Now, since COVID, the market has been pumped up quite a lot. Okay, there's been a lot of cheap debt available. There's been a lot of quantitative easing, and interest rates were cut and remained low, and that is going to rise asset prices. We're now seeing reversal out. We're seeing quantitative tightening. We're seeing interest rates go up. This should see a pullback. This is natural. This is maths. And when I talk about markets, I'm talking about generic markets, right? Of course, there's going to be regional variations. Okay, there's going to be variations in demographic. There's going to be variations between the investor world and the homeowner world. There's going to be variations in property type, which is why when we do some sort of how-to training, which I will be doing, some live how-to training on building your property business after Easter. By the way, if you want to dive on some live how-to property education, my aim is to decommoditize education. I think education, knowledge without execution is worthless anyway, so it doesn't cost me anything to put out everything that I've sort of learned over 15 years of buying and selling property. If you're interested in that, put your hands up, put a thumbs up, put something in the comments. Make sure you subscribe to see the notifications of when we do that how-to training. Anyway, the point I'm making is it's so important to understand your own micro area, okay? You might have heard in property investing sort of how to dominate your area, dominate your ground. I'm not saying it right now. There might not be some micro areas that are being very buoyant, right, for investor demand. When I look at this data, I'm looking at big picture statistical data, okay? So just on that, I am going to dive into some more data sets today, some interesting data sets. You can make your own conclusions with that. And just before we run into that, just to finish my own personal view, okay, again, if we zoom out, property market is cyclical. Things cannot carry on going up in a straight line, okay? I want things to pull back a little bit right now. I want some of the air to come out the market because it has been a very hot market over the last couple of years. I think some of the air coming out is good. So I think it brings property prices back in line with affordability, which I looked at in a previous video. And also as a property investor, I am fully engaged right now since Christmas. So just to give you a bit of an explanation about what I do in my business. Since COVID, I kind of stepped away from social media, stepped away from sort of training, from mentoring others to focus on growing some businesses. I've been growing a group of scaffolding businesses for the last 3 years. I've not been doing a huge amount in property. During lockdowns, I picked up about £1.6 million worth of property in my own personal portfolio with some motivated sales that were kind of triggered by COVID and various and another reason. Then the market went bananas and it's been difficult to get good deals. Right now, with the market, and I believe we're in a pullback, increases motivation. Baby boomer generations, I think a lot of the motivation comes from baby boomer landlords who are exiting the market, and that creates opportunity. So I'm fully engaged in buying right now. So I'm not saying don't buy property. I'm saying understand what the market's doing. That's going to drive your strategy. Personally, I wouldn't be buying land or things to flip with the uncertainty of what's going on in the market. However, with any market correction, at some point that trend should reverse, and we're always looking at trends. And when I do these live videos, I'll always look at trends. It should go back up again. Okay. So I personally am accumulating now. I want to accumulate for the next 18 to 24 months for the next cycle. I'm not guaranteeing there will be a next cycle. It could just carry on going down. We could end up in a Japanese style economy. I don't know. Nobody knows, right? At the end of the day. Anyway, so so that's what I want to stress. I'm not making any predictions. I have my own personal viewpoint. It's fascinating. I saw a thread on Facebook just this morning with people arguing with each other over, is the market coming up? Is it going down? Stats are saying going down. Other people saying in my local area they're going up. Look, guys, just be constructive. Just be data driven. Just be objective. Let's have a conversation about it. We could both be right. We could both be wrong, which is why I put that cheeky thumbnail. I might be wrong. I might be wrong. It could be completely bizarre and wrong. And trends reverse, by the way. That's another big thing to say. External factors. I'm creating a video right now about the banking crisis. It seems to have quietened down at the moment, which is good, but trends can reverse with external factors. War in Ukraine could end. Government got an election coming up in, 18 months, something like that. If things get really bad in the market, could they change their policies? Could they reverse from QT into QE, quantitative easing? Could interest rates come down again and re-stimulate? Could that pump up asset prices over the short term to a point where they catastrophically fail, rather than a pullback now, which makes it more affordable? Who knows? We're just going into the data. Right, and on that, and by the way, hello everybody. If you're just coming on, say hi. We've got Lek in sunny Cornwall. Hello, Lek. SH, good morning. Ben, good morning. As we go through these lives, and also if you're watching this on the replay, if you want to see anything specific or chat about anything specific, I do these as not just sort of lectures, if you like. I want there to be conversation. If you've got anything you want to ask, get it asked in the comments. Even if it's on the replay, I will always come back and answer them. Okay, that's just how I do it. How my style is. Cool. So let's dive into it. Let's dive in to the nationwide HPI. Okay. So Friday, Nationwide have released their latest set of figures. HPI, if you don't know, is House Price Index. There are several house price indices. Nationwide and Halifax are the two large banking groups that put out an indice. To clarify, this data is based on mortgage approvals post-valuation. Okay, so not on completions. Mortgage approvals post-valuation. It also excludes a lot of things. Obviously, it's a mortgage lender, so it excludes cash purchases. I believe Nationwide also excludes buy-to-let. So that could be statistically significant. Okay, so by the way, last week I put out a live about the UK HPI, which is based on land registry data, which is completed sales, and that lags a long time. So this is a lot less lag in the system, but it's a much smaller data set and based only on properties with mortgages. Okay, so what is the UK HPI saying? Number one, year on year, 3.1% down. I'm not particularly fussed about year on year at the moment, because last year we saw beginning of 2022 market going up, now maybe peaked and coming down. So I think it's significantly less relevant. We've got a monthly change in March 23 of negative 0.8%, which follows Feb 23 of 0.5%. Biggest thing is Nationwide is saying, what's that, 7th consecutive monthly decline in March. Let's look at the contra argument to that. This is one lender with one indice. Okay, if we compare it to Halifax, Halifax has shown the last 3 months rising. So there is conflicting data between the indices. Okay, I don't know exactly how the indices are worked out. I believe they use something called a hedonic regression model. That's certainly what the UK HPI uses. So I'm not exactly sure how they work this out. And these are also seasonally adjusted, and they've got lots of computations. Okay, this is very sort of advanced level statistics. However, we have competing data sets, Halifax, Nationwide. Nationwide is showing 7 consecutive drops, March 23 down 0.8%. Okay. If we look at what they're talking about, their mortgage approvals, you can see kind of start of this year, massive drop in mortgage approvals. Okay, we have had a slight uptick in those mortgage approvals, but statistically insignificant. And again, right, everything is like a spring, right? If you pull it and let go, it contracts. If you compress it and let go, it expands. Okay, so anything that comes down that quickly is going to have a little rebound. Okay, so a little uptick, but mortgage approvals are still very low. We can see that, yeah, look, I think it's obvious mortgage interest rates come down from that ridiculous post-mini budget, spike in interest rates. So they have drawn back, but they're still way higher than they have been. And I think this is the interesting graph if you just want to sort of take a snapshot of where we are now. This isn't house price growth in terms of actuals. This is percentage, right? So the 0% means it's not growing. Anything below that horizontal line is decline. Anything above is the price is growing. I think it's a compelling graph to see how quickly the prices have fallen, or sorry, the price change has fallen. Okay, from sort of the last 1 or 2 quarters. That's quite I personally believe that's a statistically significant drop right there. Okay, statistically significant drop, but it's one indice. I think it's gonna be very interesting looking at the Halifax when it comes out, which I think is next month. Okay, so that's the Nationwide. Let me know what your thoughts are on the Nationwide. Let's just make sure if we are all still here. Yeah, we are good. I'm just seeing if there's no more questions come in. Let me know your thoughts on the Nationwide HPI. Interestingly, if you are active in property right now, let me know your thoughts on your local area. Certainly a thread I saw this morning on Facebook was talking about investor local areas, South Wales, which, by the way, is traditionally one of the hotspots for high-yielding, low-value property. I would say the Northeast and the sort of South Wales valleys are the two high-yielding areas that's still out there that create high yields. That could be interesting because if we're seeing prices still rising in those sort of areas, it could be an indication of investors looking for value-driven property. So they're going away from things that are lower yield into the areas that are high yield, okay, on those traditional high yield areas, which will see a little microcosm or a micro market created as demand spikes in a specific area based on a specific set of circumstances, right? And again, just to clarify, this is why we need to understand what your strategy is, what area you're using. This is why we go through this data. Because it could be, right, that there might be an opportunity in South Wales valleys to go and buy stuff, right? Buy stuff cheap, find motivated sales if you can, flip them on to investors looking for value, value-driven property investors, right? Understand strategy. Now, what I want to do is look through some more data. Okay, we love stats, we love data. I want to look through some more because I don't want to be. This is doom and gloom. Okay, this is just the nationwide putting it down. So I'm going to start, and I linked to this in the actual post itself. I would like to link to some statistical research done by Christopher Watkin. Now, I've known Christopher quite a long time. Christopher is in the letting agent and estate agent market, okay, and is an absolute wealth of information, of experience and stats. So every week, Chris puts together stats with information that I don't have. I don't know exactly what the source is. It says 20 EA data, which I'll imagine is sort of driven for the estate agent market. And look at some of the stats that Chris is talking about, because I did see this headline, okay? This headline which says British property market defies critics, jaw-dropping sales figures and ultra-low fall-through. So I wanted to investigate the contra side of this of the argument of dropping prices, right? I wanted to understand the data that is leading to this analysis, because I think that's interesting. So this was the data that Chris put out last week, okay? It might be difficult to see on this exactly what we're talking about. I don't know if that's zoomed in enough, or if I can see it, I'll probably zoom it in a little bit more. Now, the first thing to say, sorry, I'm just gonna flick to this. Statistics is an interesting field. I did 2 maths A levels, including statistics. And I studied aeronautical engineering at Cambridge University, so I have quite a grounding in mathematical analysis and data. And then joined the Royal Air Force, where I spent 10 years flying fast jets, and that was involved quite a lot of mental, quantitative data crunching as we did our jobs. Okay, so I think stats is a really interesting field. You'll probably heard the phrase lies, damn lies, and statistics. So anybody can take a data set, right, and skew it towards the argument they want to make. And very often, if you've got a weak argument, okay, it's easy to take some stats and use that as a way to defend your weak argument. I'm in no way saying that anybody is doing that on purpose, by the way. I just want to say that anybody can skew a statistical analysis however they want to. So when you are looking at stats, I want you to make your mind up with what you think is going on. And as I said at the beginning, this is complex. Okay, this is not just a question of house price go up, house price go down all over the place. There's so many factors that we need to consider. So anyway, let's look at this data from Chris. So Chris is saying that every week for the last few weeks has been the best week on year for house price sales agreed. Now, I believe this is, when he says this data, it is sales agreed, not sales completed. Okay. So if we look at this graph, which shows this year, 2023, versus 2019, 2018, and 2017, we can see that so far the year has followed the trend. So it's not like there's a massive fall off in demand. Now, this is listings, by the way. This is not sales agreed. So this is listings. We can see it's followed the trend. The trend is start of the week is generally low, and over the first 4 weeks, it kind of rockets up, and then we kind of sort of sit around a mean for the next however many weeks. Now, interestingly, when we look at this, when we talk about, or when Chris talks about house price sales or listings get better every week, that's what we'd expect. at this stage of the year. Interestingly, this graph excludes 2020 and 2021. The reason being that was a statistical anomaly due to the rising market. Now, personally, my view is if you're removing data sets, you are skewing the statistical analysis, because you can't just remove a data set of the peak, right, and then look at averages with the peaks removed, okay, without taking the troughs removed as well, if that makes sense. So I believe that's slightly skewed. That's my personal opinion. If we look at, this is something I do want to look at. We've got a cumulative gross sales year to date, week 12. So this is a week 12 analysis of every year for the last 6 years. Now we can actually see on this that for week 12 in 2023 is the second to lowest cumulative gross sales. And if we look at net sales, which is gross sales minus the fall throughs in an estate agency pipeline, it is the lowest. Okay, which is interesting. And the arrow here says we're 93.6% of the 2017, 18, 19 average. Personally, I feel statistically a drop of 6.4% on the average when we've minused the 2 big years over the last 2 years is statistically significant. So what that shows to me is we've got more sales dropping through than average. And I actually worked out the averages on all these years, and it's a decline. So 2017, the average is 82.6%. And then it goes down to 79.3, 79.2, 78.7. 2023 is 76.3, which is the lowest percentage of net sales, i.e. there are more fall throughs. So we can spin this however you want. I actually spin this particular data as a good thing to the property market, bizarrely, because the biggest argument that the property bulls have right now is supply demand. So they say there's massively more demand for UK property than there is supply. And this is true. This is always the case in the UK. Again, when I look at the contra argument to house prices dropping, the main argument is supply and demand. We're not building enough houses. There's not enough units compared to population growth. And so therefore in the UK, there will always, well, I say always, that could change. The likelihood is there will always be a supply and demand imbalance. There'll always be less supply compared to demand in the UK. And that will historically and in the future keep property prices long-term macroeconomically going up, even if we have variations along the way. So if we're in a contraction right now, my viewpoint is it will reverse at some point because that supply and demand factor is going to be there. However, right now, okay, we're seeing houses fall through. My personal view is the property market could really crash and go ugly if we have a massive influx of supply. Okay, so just to go through that again. If we're seeing a tightening up in supply or a lack of supply coming to the market, that will probably prop prices up. It is the increase of supply that I think will be the big factor that would actually create a market crash. So if you look back at 2007, 2008, there was a massive, sort of spike in supply as people were, getting repossessed, defaulting, selling their properties. Obviously, there's so much stuff going on there. So many interlocking factors: banking, credit crunch, banks going bust. But if we have a flood of supply, that's the thing that I believe would trigger a much bigger drop in prices. With supply staying as it is or tightening up, that's probably going to support prices more than it's going to drop it. We will maintain this data or maintain looking at this data and these trends over the next months, quarters, maybe even years. I hope that makes sense. Right. Let's get into the next piece of statistical analysis from Chris. And by the way, this was a graph. I don't know if you can see this very well. This was a graph that really sort of stood out to me. Now, this is the national number of price changes. Again, week 12 between 2017 and 2023. And we see when we say price changes, what we mean here is price. I'm going to say price reductions. It could be price increases. I think it's probably unlikely in the current market. These are all price increases. So I would imagine in general, they're going to be price reductions. Now, if we look at this week 12, by quite some way, we have the largest amount of price reductions. I worked out percentage, okay? The average from 2017 to 2022 is 12,580 price drops. In 2023, we've got 19,430 in week 12, which is a 55% increase. So if you take the average of the last 6 years, okay, we've seen an increase of 54% on price reductions. So what does that tell us? Does it mean that vendors over the last few months and certainly a year have been thinking they can get a lot more, and now they're becoming realistic? Does it mean that they're becoming motivated and we're starting to see a lot of price drops? What do you guys think? Anybody active in the local area seeing price drops? Do you think you're seeing an increase in price drops? I believe that is a statistically significant figure. 54% increase on the average of the last 6 years. And again, I'm just going to flick back to this. We can spin it however we want it. I'm just putting the data out there. I want you to make your own conclusions of what's going on. Okay, lies, damn lies, and statistics. We can spin it however we want. What's your views? Any? Good morning, Shakti. How are you doing from Wales? Wales. Are you investing in the South Wales, Shakti? What are you seeing in the market? Let's keep the conversation going. So, all of this is going to go into the more in-depth and succinct piece of analysis I'll put out in a video in the next couple of weeks about what is actually going on in the market, because I still feel there's pulling factors out there. Okay, I talked last week about trailing indicators, leading indicators. Some people would say the leading indicators are showing everything's good. Some people saying their local areas price is still going up. This might be the case. Trailing indicators are trailing. It could be rear view mirror. We could already be in a boom again, and we don't know it. Also, we could be in a massive crash, and we don't know it because of those trailing indicators. So I delved deeper. I wanted to find everything I could for this live stream to talk through with you. So the next piece of statistical analysis I would like to go through, right, is the mortgage and landlord possession stats for Q4 2022. Okay, it's the most up-to-date one, October, November, December 2022. Why do I think this is relevant? I think this is an interesting, almost lagging and leading indicator. So it's a lagging indicator that we're looking at data from last quarter. Is it a leading indicator of the trends of where we're going? If you look at what happened in 2007, 2008, you'll see there's a massive spike in repossessions, people defaulting on their mortgages for various reasons. Most of it due to the fact it was people were getting mortgages without even having to declare their income, right? So they weren't stress tested like they are now. Another argument for why we're not going to go into full-on meltdown because of stress testing. I get it. However, let's look at what's happened. Main points. Mortgage repossessions compared to the same quarter in 2021, mortgage possession claims increased by 23%. Orders by 50%, warrants to 88%, and repossessions from 134%. These are, I believe, statistically significant percentages. Landlord possessions, this is landlords evicting tenants, possession claims increased by 42%, orders by 135%, warrants by 103%, and repossessions from 98%. Again, statistically significant percentages. However, let's zoom out. Right? If we actually zoom out and look at the graphs, it's from a really low base. So yes, they're going up quite significantly, but from a base that's much lower than pre-COVID pandemic, pre-pandemic conditions. So do I think this is suddenly going to is this a sign that the market's going into meltdown? No, absolutely not. Okay, when we went into COVID, there were lots of laws put in about repossessions, about evicting tenants. There were a lot more protections put in, and the banks help people by pumping out lots of cheap money. Remember mortgage breaks, 3 month mortgage breaks. So understandably, everything in terms of repossessions, possessions, all that sort of stuff fell off a cliff, went down from a fairly standard base to a much lower. However, we're now seeing a trend of it coming back. And look, this isn't like Q4 2020 or Q1 or 2 2021. This is Q4 2022. So we have had some time now for this to filter back into the system in terms of getting back on track with this. I think it's interesting, again, just to look and monitor the trends of where this is going. It could just now plateau off below pre-pandemic levels, or it could be the sign of more happening. So that's one thing to look at. And it then triggered me to look at, right, if this is what's going on with possessions, mortgage possessions and landlord tenant evictions, what's actually going on with arrears? I think this is probably one of the most interesting leading indicators we can look at is what's happening with mortgage arrears, okay? So I found UK Finance mortgage arrears and possessions update. Again, this is Q4 2022. And I just want to make it easy by going into these graphs. So remember, this is Q4. Now, again, I'm not particularly fussed about the actual figures. I want to look at the percentages. So if we look at here, okay, this top graph, number of first charge mortgage loans in arrears, representing over 2.5% of the outstanding balance. So people who are in arrears of 2.5% of their mortgage value. Homeowners increased by 1%. It's not an awful lot, right? Statistically insignificant. Landlords, buy to let, increased by 5%. I thought that was quite interesting. I think the 5% increase is quite statistically significant. Now, if we look at the next graph, this is homeowners in mortgage bands. So we've got bands of 2.5% to 5% of the balance, 5% to 7.5%, 7.5% to 10%, and over 10%. So with homeowners, okay, we've had a 5% increase of homeowners go into the arrears band of 2.5% to 5%. Flat on the 5 to 7.5 and the 7.5 to 10, and then a slight decrease of arrears over 10%. Okay, so that's interesting. So we're seeing more people go into the lower band, which means we're starting to see more arrears go in. With the landlords, this is even more interesting, right? People going into the arrears of 2.5% to 5%, 12% increase. 12% increase. So again, I believe that's statistically significant. Now, if we look at the graphs, again, you can see on this graph, okay, we're still below pre-pandemic levels. It dropped, and now the reversal or the trend has potentially reversed. Now, what does this mean? For a start, we're talking about an arrears band of 2.5%. So the data starts when people hit 2.5% arrears. I did a little bit of number crunching to work out what that is in terms of monthly payments. So if you've taken out a brand new loan, okay, 2.5% would represent 5.2 months of non-payment. If you've got a full loan, 75% loan to value mortgage, day one, the value of that to get to 2.5% is 5.2 months. So people are not even going to trip onto this or tick onto this piece of analysis until they're 5.2 months. Now, look, it could be much lower than that, right? Because the loan might be significantly paid off. But let's just say 5 months. So the point I'm making is you're going to have to miss quite a few payments before you even appear onto this graph. So right now, do I think this is significant? Probably not hugely, but it's definitely something I'm going to be wanting to watch for the next few quarters to see if that trend continues. Because, right, if people are starting to struggle over this winter or now, right, fixed price mortgages coming to an end, cost of living, for landlords especially, tenant issues, all of that sort of stuff, it's going to take months to actually filter into these statistical sets. So am I saying this is the market meltdown? No, I just think it's interesting data to look at. Okay, I hope you agree. There's interesting data to look at. The thing that really stood out for me on this is that the buy-to-let, right? The buy-to-let is significantly or changing more significantly than the homeowner. I have said, since I started this channel, I've said the opportunity, right? If you are in property as an investor, developer, property professional, for me, the opportunity, let me just come back over here, is retiring landlords, okay? We've seen an exodus of landlords. There's been a net decrease in properties in the private rental sector on the market for the last several years, okay? We're seeing baby boomer generation who've probably been building their portfolios, 90s, noughties, seen significant equity uplift. They're now seeing changes in regulation, changes in legislation, changes in tax, right? Potential of a market peak. They're going, right, now is the time to exit. It's too difficult to be, a landlord in my 70s with these new regulations, EPC changes. It's top of the market cycle. Let's sell now. And this is where I believe the opportunity is, right? I'm literally heads of terms agreed last week on exactly this scenario. Landlord in 70s, fantastic bit of real estate in the middle of Chester, mixed use, commercial, multiple flats. We've bought that with what I believe is a significant market discount on market value. This is where I believe the opportunity is right now, okay? In terms of the overall market, where we're heading, next set of stats that comes out, which I think is going to be quite interesting, is the Halifax, because they've been showing some successive rises. I'll be interested to see the next Rightmove data. The last Rightmove data that came out showed on average 3% increase in listing price. Rightmove index is about listing price, not sale price. We can see from that bit of info from Chris that I think the price changes in this week have changed a lot. There's been a lot of price reductions in the last week. Maybe that is just some sentiment cooling and people being a bit more realistic in looking to sell their houses. Okay, that's my analysis for this week, team. Still managed, I wanted to try and do this in 20 minutes. I think I've been on for half an hour. If there's any questions from anybody on, Lek, sorry, I need to... One of the issues with getting a little bit older is your eyes go. So I'm trying to look at the comments on the screen. And without my glasses on, I actually struggle. So Lex saying, can see slowdown in Cornwall, so no more bidding wars, but not much on the market, which seems to show kind of what I talked about. This that supply and demand is, I believe, propping things up. Rob, do you think that the new thing coming up with the EPC will have an impact on property prices? Yes, I absolutely do. I think my gut feeling, and now I might be wrong about this, but I believe it's still not ratified through the government. I believe it's not been stamped. So it is, it's a piece of legislation that's coming through. If anybody doesn't know, and this is quite a significant thing if you're already in the market, right? EPC regulations at the moment to rent out a private property, you have to be E or better. The proposal is from 2025, all new tenancies will have to be a C or better. And then I believe it's 27 or 28, all existing tenancies have to be a C. So you have to upgrade your rental property to be a C or better. I do not believe this is officially law yet. It's got to go through and get everything signed and all that sort of stuff. However, it's clearly going to come in. The exact dates and the exact detail, might vary, but I think it's clearly going to come in. Do I think this is going to affect property prices? I think it is one factor in a combination of factors that is leading to landlords exiting. I think if we look at supply demand, homeowner, right, there's still way more demand than supply, potentially. I would say in the private rental market with landlords, a net reduction on private rental sector landlords, that implies to me there's more supply in the private rental sector. And I feel this is one of the things that's adding to that. If there's more supply, by default, prices will probably come down or soften, okay? So there's a lot. I saw some data from Rightmove that said 56% off the top of my head is the amount of properties in the UK that are worse than a C. And there was something that's over 1 million properties that will never be able to be upgraded to C or better, okay, in the UK. So people are going to have to put an outlay. Now, depending on what stock you have will depend on the outlay that it's going to cost. I believe the cap they're looking at for this is £10,000. So if you have to spend more than £10,000, you'll then get an exemption. So you spend 10 grand, they're not going to expect you to put any more money in. But 10 grand per property is a lot, especially if you own a 60, £70,000, terrace in one of the more higher yielding areas. That's a significant amount. And different properties will need more to get up to a C. So inevitably, you will see landlords probably selling property at a price that means somebody else can come in and add the value to get it up to a C. So somebody's not going to buy it if it's going to cost more to buy it and do it up than it's going to be worth afterwards. However, again, this presents an opportunity. Again, if there's an increase in supply in the private rental sector, the opportunity is there to be able to negotiate better purchase prices from landlords who are selling because of this. Again, could be baby boomer, tired landlords, accidental landlords who don't want to. Maybe they don't have 5, 6, 7 grand, to upgrade their properties. They're going to get rid. Opportunity for people to buy at a good price. If you know how to negotiate, I'll do a video on that in the future. Good price. Add, do the work to get it up to a C. You've added the value. When I talk about, and when I, go and look at some of the how-to videos I'll be putting out, two things that we look at. The ability to add value and the ability to generate cash flow. That's how you build a profitable property investment portfolio. I believe this is an opportunity that we can buy things to add value onto. Just an aside for that, my personal strategy is not standard buy-to-let anymore. For a lot of these reasons, for a lot of the legislation that's changing, I favour non-residential buy-to-let investment property, commercial, mixed use, apart hotels, that sort of thing. And again, I'll be putting a lot more content out about that. And by the way, don't get scared about the thought of doing things like commercial, mixed use, apart hotels, serviced accommodation, just as easy as buy-to-let, if not more easy, as long as you know what you're doing and you've got the right management processes in place. But I love commercial. Everything is skewed towards the landlord's favour, whereas in residential, it's increasingly becoming skewed towards the tenant's favour. Okay, any more questions? Right, sorry. Glasses going back There we go. Yeah. So yeah, 56%. There we go. That's a good piece of data in the mind. Yeah. I hope that answers the question, Lek. I can't be more definitive. My gut feeling is yes, it will impact prices. Ben, hi Rob. What are your thoughts on Cardiff Bay, etc., apartments, service charges, and such? Good question, Ben. So something that I would say is personally, I only know my own investment areas like the back of my hand. Other areas around the country, I wouldn't have the authority to speak about in terms of what's going on in that local market, what I think about it. But what I will do is I'll talk about an overall picture of things like blocks of flats, apartments, service charges. My view as a professional property investor is I would not be buying flats in blocks of apartments. I would not be buying leasehold. I would not be buying things with service charges on. I think if you look through history, they're generally the most susceptible to price changes. Look, this is a totally blanket comment, by the way. I'm not saying you can't go and get amazing deals on leasehold flats in blocks of flats. Generally, when developers build blocks of flats, they sell them at a premium. And you see flats in rising markets, blocks of flats being sold, nice glossy brochures, real estate sales agents with big presences selling these to investors on percentage yields, probably overpriced. And therefore, when you see the correction, these are things that really devalue the most because they've probably been sold overpriced in the first place. Just to give you an example, a few years ago, I did probably one of my quickest flips ever and best flips ever in terms of time to money that comes out of it, which was exactly this. It was a flat in a block. It was in the northwest in a place called Middlewich. Was it Middlewich or was it Northwich? It was Northwich, actually. It was just next to Middlewich. Exactly this. So 2007, block of flats. A lot of the blocks had been sold to investment consortiums. I think they were Irish investment consortiums. Sold way overpriced. I think they were selling these flats for £140,000, £150,000. Market crashed, bottom fell out, and then these things dropped to £110,000 following that in terms of the sales. Now, we were able to secure one of these flats for, I think it was 80, off the top of my head, it was 78 to £80,000 as a cash purchase, very quick cash purchase. We just hit the vendor's circumstances at the right time. I think from memory, this came through a sourcer, actually. They're about to get repossessed. So we were able to come in, buy it before the repossession in cash, flip it straight back. It was moving condition, nothing wrong with it at all. Literally picked the keys up, bought it £80,000, picked the keys up, walked down estate agent road, gave it to a different estate agent, said, get it back on the market, put it back on the market at 100 grand, 105 grand, I think it was. And we sold it for 100 grand 2 weeks later, made 20 grand like that. So my gut feeling is personally, it's not something I would be investing in. If I'm buying flats, and by the way, I love flats, just not leaseholds in big blocks. I love flats where you own the freehold and you own all the flats. So whether you are buying existing blocks of flats, I put a video out last week. Go and watch that if you want it, with a freehold building, 2 commercial units, 7 flats above. Fantastic deal. All on one freehold, you control the whole thing, right? And then high density units, multiple flats on one freehold, great for renting out and getting much higher return on your capital. So I like that. Commercial conversions, I really like, or blocks of flats where you can operate them as bespoke sort of serviced accommodation units. Apart hotels is kind of my flavour right now. In terms of the Cardiff area, not sure I know an awful lot about it, if I'm totally honest. I'd imagine it's probably pretty popular with investors. And I'd imagine there's probably quite a lot of development that's happened over the last 10, 15 years. Probably quite a lot of these blocks of flats that have come up. So I don't know if that answers your question, but that's my gut feeling. Would you recommend buying properties in a limited company? Okay, Ben, again, this totally depends on your personal circumstance and situation. So let's just go through the pros and cons of each. If you buy in your limited name, if you buy property in your own name, okay, you are going to be subject to Section 24 tax. Section 24 is this delightful legislation, tax change that the government put in, which means we can't offset mortgage interest against our profits, okay? So as mortgage rates go up and therefore the interest element of your mortgage goes up, this is going to get even worse. So the last 4 years have seen a lot of property investors' margins
compressed because of this. And now with interest rates rising, it's going to be compressed even more. Because if you imagine those interest rates, the interest percentage of your mortgage, if you're on a mortgage, is going to get bigger as the interest rates go up, which means you've got even more cost, which you can't offset against your profit. So let's just take this to an extreme. Let's say you rent something for £500 a month. You had an interest-only mortgage where you were spending £200 a month on your interest. Okay, so you're making £300 profit there. However, you're going to get taxed on the whole £500. That's a fairly simplistic. There are little allowances, 20% relief, all that sort of stuff. But let's just go big picture. Now, let's say, right, that interest-only mortgage comes to an end of its fixed period and it goes up from, let's say it was 2.5%, goes to 5%. Okay, or maybe even 6%, I don't know, right? But let's just say, let's take an extreme and say that £200 interest is now £500 interest. So you're renting for £500, you've got £500 interest on your interest only, you're making zero profit, but you're going to get taxed on the whole £500 profit. Sorry, not profit, £500 rent. Okay, so Section 24 is a bad thing. Now, one of the arguments for going to a limited company is in a limited company, you do not have Section 24. Okay, so you can offset your finance costs against it. However, if your personal tax rate is already low, if you're less than a higher rate taxpayer, Section 24 doesn't really affect you, okay, for a start. And if you incorporate and go into a limited company, there are lots of additional costs, right? So there's the administrative costs of running a company. Accountants, you're going to be spending £1,500 a year on accountancy alone, right? So if you're just going to set up a limited company for one property, it's going to be unrepresentative. They're also changing corporation tax rates in there. So 90% now ratcheting up to 25%. Something they've really changed recently is dividend rates. So yes, you can potentially offset that Section 24 in a limited company. But then to take that money out of a limited company, if you need the income to live off, right, you're going to pay corporation tax first, and then you're going to pay a much higher dividend rate tax on the money you take out, because the dividend tax rates have changed considerably as well. So ultimately, to try and loop around to your question, it depends on your long-term goal. It depends on your personal situation, what you're trying to do. I do all of my stuff in a limited company. The reason I do that is I view my portfolio as a long-term legacy building thing. So a lot of the income that comes out of my property portfolio, I actually live very modestly, as a life. And I'm going to be doing some videos which kind of bring you a bit more into my world, what I do on a day-to-day basis, how I run my businesses. And I've got multiple streams of income, by the way. Property is just one of them. I also have businesses, scaffold businesses, I have other investments, and day-to-day trading stuff. So my property business, various limited companies, depending if I'm working with investors or if it's just my cash. So I generally set up separate limited companies with investors if we're creating a partnership. I generally leave the money in them. I take out enough to kind of live and pay my bills. The rest of the money stays in the limited company to avoid that dividend tax rate, because it's obviously going to compound growth much more quickly by leaving it in the limited company and reinvesting it. Now, of course, by reinvesting it, it means I'm not taking it out and living off it. There's no Ferraris, there's no Lambos, there's no super yachts. That's how I choose to grow my wealth. Then at some point in the future, I view that as a legacy platform to hand to my children. Okay, and I'm not going to go into succession planning and all of that sort of stuff here on this, but there will be a much more tax efficient way to pass that on to the next generation, wrapped up in that wrapper, rather than just having lots of property in my limited name that I die and inheritance tax, all that sort of stuff. So I don't know if that answers your question. It does depend on your personal circumstances. I have all of my stuff. Everything I buy now is in a limited company. But the economies of scale mean like that accountancy fee obviously is greatly reduced in terms of percentage of the income, and yeah, it all gets reinvested. Other things to talk about limited companies is it's easier to get mortgages in your personal name. Okay, when you're getting started, a lot of people just say, let's set up a limited company. I think it's bad advice, by the way. Just say you have to set up a limited company. I think it depends on your circumstances. Limited company, there are limited company buy-to-let mortgages. They're generally more expensive. You're probably going to have to put personal guarantees in anyway. And it generally costs more to get financed through a limited company than just going out and getting a buy-to-let mortgage, as an example. So lots of factors to consider. Hopefully that answers your question. Cool. Any more, team? Let me know if that was a useful session. my aim is to try and get live once a week on the channel to sort of talk through what's going on in the world, to sort of go through a Q&A sesh. As I said, I plan on doing some actual sort of formal property teaching through this channel live. If that's of interest to you, just put a comment in, put a thumbs up, something like that, if that is of interest to you. And I'm going to think about the best way of doing that. But I'd probably do it live rather than recorded. I did think, do I just do a load of recordings, put them out? But I think I prefer to do them live and do some live sessions, going through some sort of property training. So if that is useful, then please let me know. You're probably asking, why would I do this? Why do I do this channel? At the beginning, we talked about stats, statistics, more statistics and lies and all that sort of stuff. I'm gonna end with this. Everybody has got an agenda. Okay, I would like to be totally transparent about agenda. Everybody who puts themselves out on social media, whether it's business or personal, you've got an agenda, right? You post for a reason. It could just be because you want to make yourself feel better about life by posting snapshots of, Lambos or things like that. It could be that you're trying to drive business to a particular business or company. So everybody has an agenda. That's really important to understand. My agenda is to give as much value on this channel as possible, to get as much reach as possible, right, and build a community where we can have open discussions, where we can look at what's going on and we can learn together. Why would I do that? 2 reasons. I'm not a guru. Okay, I don't have a big training company. I don't have a beast to feed in terms of pipelines and putting people into events. I don't do any of that stuff. I don't sell courses. I don't believe that courses, by themselves work. I do take on private clients who I help coach and mentor through their own journeys. Generally, people who are looking to build significant portfolios, okay, or buy and sell businesses. That's the other thing I do. So I work with a very tight, small group of people where I help coach and mentor over a 12-month period. Okay, that's the first thing. Second thing is I'm out actively buying stuff at the moment, and therefore I'm always looking for joint venture partners, investor partners to work with to buy more stuff. That's where 90% of my wealth comes from, is my property portfolio. Right now, I believe, is the best time, or I think we're going into a really good time of opportunity for the next 18 to 24 months to accumulate. So I'm very active in the market at the moment. So that's why I do this, as well as actually just quite enjoying it, and I hope it does add value. Okay, so if anybody ever wanted to chat to me about anything like that, just drop something in the comments, and I'll send a link over. We can have a chat. Okay, awesome, guys. I've been live for almost an hour, so I'm going to sign off right now. I will hopefully see you next week at some point on a live, and I hope you have a fantastic week and a fantastic Monday. I bid you a very healthy, happy, and productive week.